Everybody, welcome back to the channel. Today I'm going to talk to you about liquidity, and we're going to talk about hooks, why are they important, and a little bit on the AMM, the automated market maker. So check it out. Hooks, smart contract proposal for the XRP Ledger. This is what hooks is. Hooks add smart contract functionality to the XRP Ledger, layer 1 custom code to influence behavior and flow of transactions. Hooks are small, efficient pieces of code being defined on the XRP Ledger account, allowing logic to be executed before and or after XRP transactions. The XRP Ledger is known and is being appreciated for its transaction throughput, speed, and low-cost fees, combined with the available advanced transaction types like multi-sign escrows, payment channels, and even a decentralized exchange, all on Ledger out of the box without requiring smart contracts. The XRP Ledger has a lot to offer businesses and creative developers. All right, so this is Crypto Eerie talking with Krypton Raider about hooks, and it's a big deal. This is side chains for the XRP Ledger. Let me play this.
Having no incentive on the main chain is, I think, is key, but the beauty for side chains is, and even for forks, you don't have to build a side chain. You can also fork the ledger because the license model allows it to do it. But the beauty is that you are free to shape the side chain in a way that fits your business or fits your network. For example, you could build a canary network that copies the XRP Ledger, the public one, because you want to, in our case, for example, you want to test out the hooks amendment on a canary network-like basis, or you want to change.
Canary network's like an off-chain network, like Songbird and Flare, right? Songbird is there to test everything before it actually goes onto Flare. It's their canary network, their test network.
The whole structure, you want to go away from blockchain and want to go to a directed acyclic graph structure, completely different structure, or you even want to combine it. You want to do both. You're free to do whatever you want. You can change basically anything on the side chain and be free to do it and test it. And if it makes sense, you can port it back to the main chain and ask the community on the main chain to implement it or not by using an amendment.
So basically you can create custom code, custom apps on this side chain of the XRP Ledger that is not connected to the main chain, test all of it, make sure it's working good, and then you can bring it onto the Ledger. I'm not going to play the rest of this, guys, but it's a great clip. If you want to look up this clip, just look up XRP Ledger hooks sidechain with Raider. There's also the AMM. I played this in my other video, but it's important that we hear this, okay? This is very important, right? This is where liquidity comes from. AMM. This is what we need.
More transactional volume, the more people who are going to stake the pool. Therefore, deeper liquidity. And the deeper liquidity, the more volume you can run through, run over.
Because the deeper the liquidity, the more volume you can run through. We can't process trillions of dollars right now in the XRP Ledger, right? We need liquidity to do all of that. And that's going to come with AMMs.
Transaction fees are so low on the XRP Ledger and the transactions are so fast. That means arbitraging is going to be more efficient and the pool is going to be able to capture more volatility for yield. XRPL's low transaction fees, high transaction fees make arbitraging so much more competitive and so much faster that it reduces the pool's arbitrage losses and increases the pool's volatility gain. The consensus process doesn't allow any party to be the dictator of the moment to run the block. This makes arbitrage slots more valuable and should increase the returns on the continuous auctions, resulting in more liquidity token destruction and more yield. One of the disadvantages of holding assets like XRP and Bitcoin is their volatility. All right, why do we have stablecoins? Because volatile assets are hard to hold and use. I'm hopeful that this combination of features in the AMM specification will turn that disadvantage into a significant advantage. AMMs will harvest volatility for yield. Volatility will drive market makers, which the AMM makes a spread, right? If the price of Bitcoin stays at $20,000, eventually everybody who wants to buy at $20,000 is bought and everybody who wants to sell at $20,000 is sold. It takes a movement in price to really drive that volume. And of course, volatility increases arbitrage or profits because the AMM gets more out of balance more, and the AMM gets a cut of those profits through the auction mechanism.
So this could really turn the volatility of a digital asset from a downside to an upside. Super excited about it.
And automated market makers are poised to become a major cornerstone of global crypto liquidity across all assets and multiple chains.
And multiple chains, guys. That is what we're waiting for, right? Also, from Crypto Eerie, there's a reason Ripple applied for Hong Kong proof of concept clear regulation as one of 16 firms, along with Alipay, Bank of China, HK Shanghai, Banking Corporation, and others, all will showcase programmability, tokenized offline payments for tokenized settlements, right? Stocks, bonds, etc.
But in terms of virtual assets, the philosophy that we have is very simple. This trend will continue. And plus, virtual assets of crypto is actually a very broad term. It's not really just unbacked crypto. You're talking about stable coins or tokenized assets in the future. So what we want to do in Hong Kong is to say that, hey, this trend will continue. Let's put in the right regulatory framework in using the principle of same activity, same risk, and same regulation. So our regulation will be tight. If you perform any activity that resembles traditional finance, we'll put in the same regulation to you. But under this regulatory framework, whether it's the trading platform for crypto or in future stable coins that we are going to have a legislation, we are working on that. But so under this regulatory framework for trading platforms, stable coins, etc., we will let the industry develop and innovate. We will let them create the ecosystem here. And that actually brings a lot of excitement. But that doesn't mean light touch regulation. If any participant thought that the regulation is too tight, they're welcome to go elsewhere. So we have this regulatory framework. Let's develop our ecosystem here in a healthy and sustainable way.
I love it, man. You got to love Hong Kong, really putting the time and the work in. I don't know why I have this here. Okay, cool. I wanted to get into this. So there's this really good video here called Solid Facts, Liquid Truths, Building High Liquidity Digital Assets. And there's a bunch of people on the panel. There's someone from Ripple on the panel. But let me just give you a little bit of taste of this. I'm going to play 3 clips. Listen to what they're saying because it's really interesting.
I guess, how does market making in the crypto space differ from that of traditional finance?
I think there's some uniqueness with liquidity, uniquely important. So if you have when you're trading a token, it has a number of properties that actually make the network function. And without that liquidity, the network doesn't function. That's not really the case in capital markets. If you're driving your Tesla, it doesn't stop because liquidity drains from the Tesla share price. Nothing happens, you keep driving your Tesla. But if Ethereum doesn't have liquidity, you can't process your transactions, you can't validate the network. So that means that being a market maker in this space, you can do market making as a service, and it becomes increasingly important as you're taking your disruptive technology to the market and trying to scale it. And that's why people like us and other people have been able to build very big client franchises as market makers, as opposed to being, buying order flow and trading hostile or toxic against the market.
All right, so he said a lot of cool things there, right? But market maker as a service, right? We have nodes as a service. That didn't go very well, but we have software as a service, all of these different things, right? Now we're talking about market making as a service. Let me play this one. This is talking about what is the state of crypto liquidity.
That's good.
Can I just chime in here quickly?
Yeah.
So
This is
in terms of describing the state, I feel something really key happened in this last adoption spur 2020, in the sense that, crypto, in terms of just the market size overall and also volumes, have reached critical economic mass in the eyes of even the largest financial institutions. Before, it was predominantly retail driven, and now things like, Bitcoin achieving 10% of the market cap of the whole gold market, or a company like Coinbase with 1,500 people generating revenue commission income the size of traditional investment bank with 50,000 people. It's just really open up the eyes. So it's fair to say, in the eyes of traditional large institutional players, this place has become too big to ignore. No, it's not a fad. It's not going to go away anymore. And so all of them are looking for an entry now. And also regulators, which are obviously, key stakeholders for the whole, adoption to thrive, they can no longer ignore it. So as these two dynamics now are playing out, that will just underpin so much more liquidity growth from here as I see it.
So what he's talking about there, guys, is he's saying that these big institutional banks with 50,000 employees saw Coinbase IPO and make so much effing money that they're like, holy shit, we're missing this market. We need to get into this market. And that's why you're seeing BlackRock and all these big names coming in, Invesco, Bank of America, Charles Schwab. All of these guys want to get in and they want to make money. They're there to make money, and they see all of this money that's going to happen. It's going to come from all of these inventions. Just think about it, guys. Like, if you're an incumbent bank and you're looking and you don't think there's anything to do with crypto, that bank is going to be extinct in a couple of years, right? The banks that are going to stay in the forefront of innovation are already working on this, right? Those are the bigger banks, the Wells Fargo's, the Bank of America's, the JP Morgan Chases, right? Those guys know how important this is, and they're not going to miss the opportunity. This is my last clip, guys. Where does liquidity come from? I thought this was pretty cool. Let me play this for you.
Exchanges had different timestamps, which was absolutely nuts to try to figure out what the price was at any given point in time. Most exchanges only had REST APIs, if they had APIs at all. Now they all have fixed APIs. And so a lot of that standardization to your, a number of exchanges also used to have futures or perps derived in crypto, which created very volatile markets if the underlying token moved as well. Now most of them are derived in stable coins, which is why you've seen just the stablecoin market itself over 300% growth from last year. And so I think you're continuing to see that level of standardization, and I think we'll talk about that a little bit more as well. But to the earlier point, a lot of that is because we're servicing 50 billion plus asset managers who require that level of standardization and support, and 24/7 support and coverage nonstop. And 24/7 support is really expensive. You need to have people working weekends. You need to have people who are constantly checking books. When you think about even in traditional financial markets, when they make you take 2 weeks of vacation so they can check through your books, you don't have that in crypto. And you don't have weekends and holidays as well too. So all of that leads to the expense, but you have to do it for the type of institutions.
So it sounds like most people on this panel, sorry, Marcus, did you want to make a point?
No, just quickly to chime into this question about where liquidity comes from, I would love to talk a little bit about this from the lens of sort of use cases. And, I think everybody would agree most of the crypto liquidity right now serves sort of the use case of speculation, fueled by incentives and so forth. And not denouncing that, I think, it empowers the industry to really innovate. However, I think as as crypto matures and lives up to its full potential, I think this notion of real world utility will become increasingly more relevant. And just to give you an example, so we at Ripple, with our flagship product, on-demand liquidity, we're literally harnessing billions of dollars of XRP liquidity to facilitate cross-border payments in a couple of seconds from, say, the US to Mexico instead of your 2-3 days like in legacy systems. So really solving a massive pain point in this world, which is how money moves around the world. And these are use cases that can scale in the trillions. So I think the future of crypto liquidity will be shifting more towards solving real world problems as opposed to just speculation.
It's going to go into the trillions, guys. I mean, I don't know if you've seen my last couple of videos, but I had a clip of my last video talking about $400 trillion in tokenized securities that are going to be coming onto blockchains and DLT. Ripple's in the mix, XDC's in the mix, your Stellar's in the mix, and Quant's in the mix, guys. Those are the four. If you had to pick 4 cryptocurrencies on the planet that I think would do the biggest returns over the next 5 to 10 years, obviously I'm not a financial advisor, but those would be your XRP, your XDC, your XLM, and your Quant. Those 4 assets, if you're just hearing about those assets for the first time, do yourself a favor and start doing research, your due diligence on those 4 cryptocurrencies, all right? We can talk about other cryptocurrencies, but if you focus on those 4, I bet you in 5 to 10 years, you'll come back and say, Sensei, I'm retired now. My life is good. Thank you so much for the information. I will say thank you so much for listening. All right. I'll see you guys in the next one. Appreciate you. We're on our way to 10,000 subscribers. By the time this video comes out, we might be over it. So thank you so much for all of your support, guys. I read all of your comments and I just thank you. Thank you. I love you guys. Thank you so much. All right. I'll see you in the next one. Ciao.